The only people who have the luxury of playing it safe and diversifying over 10 to 15 things are people who already got the money. And the only reason why the so-called experts tell you to diversify is so that you don't lose your money and then you get upset with them, right? That's just the plain vanilla CYA advice.
Welcome, everybody, back to another exciting show of the About That Water podcast. I'm your host, Anthony Weaver, and the whole thing about this show is that we help the sandwich generation build that confidence so that they can talk about money, spend money, and enjoy their money the way that they need to for their lifestyle. And today, I have an awesome person who was a two-time bestseller author, a former civil engineer, and he has managed over $2.1 billion in real estate assets across 10,000 plus units with $48 million in distribution to its investors through the Wealth Elevator. Welcome to the show, Lane. How are you doing today?
Thanks for having me, Anthony. Aloha, everybody.
I'm trying to, how do you say your last name? I don't want to butcher that.
Kawaoka.
Kawaoka. Okay. Thank you for teaching that, because it was actually pretty cool. I didn't want to say, like, some vowels be like omitted and everything like that. I appreciate it. That is straightforward. So pretty much we all hear about real estate. We hear about like a lot of people determine like what is best, renting versus owning. We're just going to start right there and dive right in.
Yeah, so it depends, right? If you do the numbers and you're good at investing, you typically can get a 5, 10, maybe even higher return on your money. When you calculate your return on your money, when you put a down payment on a house, it's typically in the single digits range. So it ultimately comes up to this question is, well, how good of an investor are you? So for a very small percentage of the people out there, it makes more sense to go on the offense and invest the money, whether stocks, buy more rental properties. That's kind of my story, right? I took my money and bought more rental properties. But there's a huge caveat to this often debated question, and it takes into account the human side of this. Most people are really bad at managing their money, and if it's not, paying mortgage, which is essentially a forced piggy bank, they'll spend the damn thing. Oh, that's why despite what the numbers tell you to do, most people should, buy a house to live in. So there's that forced piggy bank component.
Yeah. So you started real estate back in 2009. Like, why 2009 was like that year for you versus waiting a little longer?
Well, so I started as soon as I could. Then 7, I graduated college with an engineering degree, and I started to work for the man. Didn't like it. But again, still up to this point, I was still brainwashed with the whole invest in the 401k, max that thing out, and buy a house to live in, right? Like I said, it's not for everybody, and it kind of wasn't for me, right? Because I was a good investor and certainly a good saver at the time, but I still did it because that's what my parents taught me to do. I had a job where I was traveling all over for work, was never home on Saturday. I was a construction supervisor, and I just kind of on the whim, I bought this house to live in, right? And I was there all by myself and just started to rent it out. And I was like, whoa, this is cool. I'm making a bunch of beer money doing this. The mortgage was $1,600 and the rents were $2,200 a month. I was making $700 a month, right?
Profit. That's a great return, yeah.
Yeah. And then I got more sophisticated about it, started to learn, that was just the cash flow component on the surface. It wasn't including the tax benefits, the equity buildup, and the big difference when you own your house, you're kind of the sucker paying down your mortgage. But when you have tenants and you're a landlord and you're in investment properties, tenants pay down your mortgage for you. So that's an additional way you're making money. And that was kind of where I was like, whoa, why would I want to put my money in the traditional investments where I could just keep rinse, washing, repeating, doing this thing? And that was when I got the bug, right? Started to buy a duplex few years later. Again, I was limited to how much money I could save. And then by 2015, I had 11 little rental properties.
So, like, because even though it was your primary and you were renting it, did you have like a separate entrance, or you like renting the room out? Like take us back to that moment.
I rented the whole thing out. Um,
Well, so where were
yeah,
you living at then?
yeah, it's a good question. Super. So I had one of these jobs where I was traveling all over for work, right? Like we'd go job site to job site. So this is a kind of a unique opportunity for me to just be homeless and live off the company dime. So I mean, before this, engineers don't get paid too well, but I was able to save 20, 30 grand per year. That's why it took me maybe about 2, 3 years to save up $80,000 down payment. But man, yeah, once I was homeless and living off the company dime, and I had a rental property making some money for me out, like there were a few years there that I was making like 6 figures, and that was all going to savings. And that's what really powered things early on.
So you mean to tell me that a homeless person could be doing this? Is what you're saying?
Yeah, I mean, I wasn't homeless, I mean, I was living in like Red Lions and Best Westerns and Holiday Inns, also getting the points for that. But yeah, that was the life back then. So like I wasn't really around to, waste my money on, nice cars or happy hours, stuff like that too. So that also helped on the expense category.
Nice. And so you had all of this going on in the back end, making the money coming through, you hopping around. But what did your colleagues were also doing this too? Or is this something that, like you just read up online that kind of got you this idea?
Yeah, heavens no. None of my coworkers knew I was doing this type of stuff. And normally, once you buy like a rental property, especially two, people start to like, you don't talk about this at work, right? Because people think that your attention is diverted elsewhere because you're a landlord. But I had a professional property management company, doing my dirty work for me. And then another thing, like my parents never did rental real estate. I didn't know any accredited investors around me, so I was kind of just going on a whim. And the very early days, I would just kind of run the numbers. On my website, we give away free courses on how to buy a little rental property. The core piece there is the spreadsheet, right, to analyze the deal you're getting into, and are you gonna make money on this thing, right? And that was kind of where early on I was like, well, I'm reading all this stuff online that you should account for 10% repairs every month, maybe 15 if things go wonky. And I'm like, this seems pretty, legit, right? And then I start renting these things out, and I, build a little bit of a cash buffer. Life was good. But yeah, certainly, it happened more so when I had more rentals, right? Like when I had 11 rental properties, it sounds good with a few $100s of cash flow each, or maybe $3,000 a month. I mean, not gonna, I don't want to come across as insensitive, but it's like that much money isn't going to change anybody's life, right? 3,000. Most of my clients today aspire to $10,000 to $20,000 or more of passive income per month. So, you're going to need to triple that or quadruple that. But that comes with more problems. If 11 rental properties, of course, I had property management on these properties, right? Still had maybe an eviction or two every single year, some kind of big catastrophe that happened on the house, like a, tree falling on the roof, or, a hurricane coming through, breaking something. And it just became a chore to manage the manager there. And then on those evictions, like 1 out of 3 of those evictions always ended up to be like a big ordeal where it costed me like $10,000 to $25,000 repairs. And it's like, wait a minute, like what am I doing this for? Like we're trying to make money here.
So, because a lot of people who listening to this, they have their kids they got to deal with and have their parents they got to deal with as well. So they kind of tight for cash. How do they like? What would be a good strategy for them who have little to no cash to kind of get into this I won't say into real estate, but actually into actually owning a separate property outside of their home?
Yeah, I mean, Anthony, you knocked it on the head there, right? The sandwich generation has just got it tough, right? Look, man, I'm not gonna lie. Like a lot of my clients are kind of right in there, like they're in their 40s and 50s or greater. But when I started, I was young, right? Like I wasn't married. I didn't have kids, so I could just be homeless for a few years and make and save a lot more money. I could, just I was mobile. I could travel, move houses a lot. So it's definitely harder when you get older and actually get more responsibilities to your name. The theory is still there though. Like the general theory is you have to buy assets that produce income or grow for you. Unfortunately, there is a barrier to entry for that, right? Real estate, you need money. I don't teach any of this nonsense about no money down stuff. You need the 20% down payment, but sometimes a barrier to entry is good, right? If not, you're playing around with all these cockamamie ideas such as drop shipping, like multi-level marketing, selling essential oil, like all these like ploys that are here one day, gone tomorrow. I mean, real estate is a time-tested thing. Unfortunately, you gotta rub together at least 20 grand for a 20% down payment on $100,000 house. Um, and I'll say that again, like you don't need like when I first got started, I was buying houses in Seattle, Washington, which is known as a primary market, like California, Hawaii, Boston, New York. Look, we don't buy properties in those places, right? First, because they're more blue states and we like the landlord laws on our side, but just the prices are just too high and you don't get the rent to value ratios that we're looking for. One quick and dirty way of analyzing these properties, you take the monthly rent divided by the purchase price, and you're looking for something about 1% or better. So if you place and kind of where you're at, right? Like things are pretty expensive. Maybe a place that's a little rougher, a little older is 400 grand, right? That'll rent for like a couple grand per month. That's 0.5%. No bueno, not gonna work. A lot of these houses I would buy would be, $100,000 that would rent for $1,000 a month. And you get the 20% down payment on the 100 grand. $20,000 is your kind of your barrier to entry there. Look, we have some guys that are younger, just getting started. And, if you're able to save $5,000 a year, it's going to take a while, right? But, look at my track record getting started, right? Like it took me a while to save the 80 grand to buy that first property in Seattle. I didn't know at the time I could have bought 2 or 3 houses with that amount, right? But the cool thing is like at some point, as you start to acquire more and more properties, your savings increases. So what took you 2 years or 3 years to save up might take you 1.5.
Based on compounding.
Yeah. Yeah. Well, I mean, every house you buy puts another, $300 a month or 3 grand per year. In the beginning, if you're saving $5,000 a year and it would have taken you 4 years to save 20 grand, the next property you buy, now you're saving what, 8 grand per year. So it might take you, I don't know, that's kind of weird, funky math, but like, a lot less than what it took you to buy the first one, right?
Yeah. So, but I'm thinking of, okay, so we get up 20 grand, but because one of the things I'm always afraid of, which is just going all in. So, could you possibly utilize any other programs like the FHA program for some of these people? Because I think it resets after every 3 years, if I'm not mistaken, after you purchase a property.
Yeah, I mean, there's like FHA where there's like less percent down payment. You got to pay, obviously higher debt service. So it's kind of a give and take there. But I do agree that that's probably a better way to do it. The problem there is you got to live in it, right? We're not doing that here, guys. You guys are renting it out. Unless you want to commit mortgage fraud, which I don't recommend, you can't do that. I mean, that's the thing here. You got to just save up your money and it's going to take a while, I mean, but at some point, usually about 5 years in, you start to really get more momentum, I think, and it starts to go. But I don't know, man, Anthony. Like, how does that sound, right? Like, does that? I mean, what's the barrier here? Let's talk through it.
Yeah. So I'm thinking of like, okay, because if you got the 20 grand, but I'm always thinking of like, maybe you should double that almost, because granted, you got the 20 grand just to get in, but what about, you have to do some fixings, like, the floorings need to be done. You need to renovate the property. Like, so
Well, yeah,
all
we
of
don't
that
want to talk
also,
about the bad things at this point, right? But no, 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 you're exactly right, man. Like,
right.
like realistically, like, when in our, again, this is a lot of this is in our, like, our free e-course. People want to go and download it. They can go to the wealthelevator.com/turnkey. But if you're buying that prototypical 20% down, $100,000 house, you're 20%, you have some closing costs in there too, right? So it might actually be 25 grand. But yeah, what's the most plausible thing that can go wrong, right? Well, you get a tenant in there, you cheer, but then they move out the next day and they trash it up a little bit, right? It could be 20 grand, like I've had, although that's on rare occasion, but more than likely, that the property goes vacant for another couple months. Maybe somebody steals your HVAC too along the way out, right? Like, these are the things that kind of happen. And you're exactly right. You got to have the money there just in case. So I think it would be prudent to have an additional 5 to 10 grand.
So, because you also want to talk about location. You mentioned that location was hot area. How do you choose where to buy your rental? Do you stay locally? Because just coming out, do you start local? Do you go internet, like, not internet, interstate, for your properties?
Yeah, I mean, by using professional property management, you can go anywhere, right? They are your boots in the ground. My first couple few properties, yes, I kind of stair step my way up being a landlord, right? These properties were right by me. I don't think that that's necessary. I would think it's more important to invest in properties that make more sense from a numbers perspective. And let's face it, most of us live in nice areas where the numbers are not going to work, and you're going to have to go to more of a secondary or tertiary market. What do I mean by secondary or tertiary market? Well, secondary markets are not the top tier cities, sexy cities where your prices are overpriced. These are going to be more like your Houston, your Charlottes, your Birminghams, your Atlantas, right? And then also, you're not going to be able to get the best rent to value ratios in the places with the best school districts, things like that, the most safest areas. That said, you don't want to go to the slumlord areas, right? We're not saying that, right? There's a nice little sweet spot in what we call the B class areas. There's always, it's little arbitrary, but you buy, there's A, B, and C class. A is your nicest areas. I'm thinking everybody listening tries to live in those areas, or is at least aspiring to. The B class is a little bit less nicer. It's safe to be there during the daytime. You may not want to be there in the night. The C class is, not safe day or night, right? But that's kind of the range. There's like a nice little sweet spot in the middle. Additionally, you know, you also grade the vintage of the property, right? Which is like the age. So your newer properties, and again, this is somewhat subjective, right? Just to call it like built 1990s or newer. It could be your class A. There, you won't get the numbers to do this stuff. Class B is going to be like your 1970s, 1980s. Class C is going to be your 1960s and older. Again, try and stay in this, like, middle of the rung. But yeah, like, what I would say is, if you're looking at a market, look at 80% of the median home price, because that's going to be the glut of your renter class right there. And this is just my investment thesis, and you're welcome to use it, although this is not investment advice at all, anything I'm saying. But I believe that, the population in America is growing, especially in the lower middle class. Certainly they're being underserved. These are the people renting apartments between $800 to $1,200 a month. And, these are the people that, not only from like, kind of a goodwill standpoint, need better options, but it's also where again, the rich are getting richer, the poor are getting poorer, and this middle class is going to lower middle class dynamic is happening.
Okay, so with this information, how do we leverage ourselves for the person that's listening to it, say that they are in that particular spot? How can they leverage themselves to go to the next level? So, with this education, like, what would they learn with the free book that can actually get them out of where they at right now?
Yeah, I mean, I think it depends on where you're at. That's kind of what I write in my book, The Wealth Elevator. Most of the people in my community are accredited investors or greater, so they make over $200,000 a year, high income earners, or they already have a net worth of $1 million or greater. The reason why, like in the whole construct of the book, is that there's different floors to the wealth elevator, right? There's the people in the basement. Like we just didn't write a book for those people, right? Because there's a lot of financial books written for that, right? People in debt, people who make less than $50,000 a year. I mean, I'm just not the guy to kind of follow for that, right? Like we kind of pick it up where I did, and everything in the book is kind of from experience, right? Things I've kind of walked my journey. The first floor is, you come out of college, you get paid a decent wage, and you're able to save, whether that's $5,000 a year, $20,000 a year, right? You're building your net worth. To me, when you're in that scale and what you're called a non-accredited investor, right? Net worth $1 million or less, you buy little rental properties. Again, that's what I did from 2009 to 2015. And then the second floor, the wealth elevator comes once you kind of cusp into accredited investor status, where now you're getting rid of your little single family homes and you're getting into more passive investments, syndications, and private placements, directly investing in these commercial assets such as apartments, right? Which you could invest in these things through REITs, but the problem with REITs is there's like a gazillion middlemen, right? And that's the big component of this whole thing is you investing directly in real estate yourself, as close to you can, cutting out all the Wall Street middlemen. And that's been a frustration of mine from the start is, like everybody works so hard to put money into the system, but very little returns go out to the end investor at the end of the day. Uh, So what I would say first is like figure out where you are in the wealth elevator. In the wealth elevator, there's like a chart that kind of shows what floor you're at, right? I always think it's good to get a little bit of self-awareness check to where you're at in the whole construct first, and then figure out what the strategy applies. Because I think, unfortunately, we live in this TikTok short reels world of all these financial tips, some good, some bad, but I overlaying the wealth elevator construct over it, like at what stage in the financial journey does it apply, right? And so that's what we kind of what I've kind of put in the book there. And I think it brings a good overall lens, especially if I think a lot of the listeners here are financially minded in this personal finance blog sphere, what I used to
They
call
better
it
be.
that. At what, some type of framework, right, of these paradigms that you go through, and when do things make sense? And also, like if I would have known what's beyond $2.5–5 million net worth, I would have done things a little bit differently when I was buying little rental properties, right? I wouldn't have bought a duplex. I would have just stick with single family homes because they're easier to sell, for example, right? So I think it's always good to know what's on the next floor above and then maybe two more floors above to kind of cut corners a little bit.
So now that you've kind of graduated to the syndication side of the house, can you tell a little bit more like what is a syndication? And first off, I'm learning this. I think I learned this maybe a year or two ago that actual group of people, I just recently learned about syndications, I would say about 2–3 years ago. Far as learning about how to actually invest in multi-family apartments and homes and so forth. So, because ultimately, I want to actually own my own hotel. That's one of the reasons why I'm interested in syndication. So, can you talk a little bit more about that?
Yeah, yeah. I mean, I didn't find out about this until like 2015 and 16 myself. At the time I had 11 rental properties and I was kind of meeting all these, I was kind of up leveling my peer network, right? Talking to all these accredited investors. And what I realized, a lot of them were kind of, doing the same thing where they were going into these syndications and private placements. So the analogy that I use is kind of like an airplane. In an airplane, you have the cockpit where all the general partners, the deal operators sit. Could be one person, could be five people, in a cockpit. And then you have all the passive investors in coach invest the money, and this is all a venture, right? We're all partners together. The plane goes down, everybody crashes, right? But the people in the cockpit run the deal. They find the deal, they get the lending in their name, so it doesn't go in the passive investor's name. They take the brunt of the legal liability. That's kind of why I think accredited investors really gravitate towards this, because when your net worth goes past $1 million, you are much more of a candidate to be sued, right? Because you're actually worth something to get. But now this allows you to go out and diversify your net worth into dozens and dozens and dozens of different assets out there. And then geographic areas, So, and then this is again where I realized like you look around, like all these big apartment complexes, most of them, are owned by institutions, right? Through a REIT format where, the Wall Street companies, the big investment companies go to Wall Street to get capital, but very little returns go to those investors, right? Most of it goes through fees from middlemen. The financial planners are another part of that whole system. But then there are some properties out there, probably the minority, that are owned by 50, 100 something individual investors, accredited investors, as kind of like a co-op, if you think about it like this in this airplane format. And that was kind of where like, wow, if you're able to find these types of groups and communities, then you're able to directly invest in these types of assets. And there's a little bit of a misnomer. Again, I'm not a financial planner, so apparently I can't really talk about this type of stuff, or you
For
shouldn't listen to
education
me.
purposes.
But to me, you want to diversify your holdings, right? Like I think it's a huge mistake. Some of my clients come in and, they come from a little bit of family money where the family owns like a 12 unit apartment in California or a 50 unit in Dallas. To me, that's exactly what you don't want to do because you have all your eggs in one basket. What you want to be doing is breaking up your net worth into smaller chunks. And that kind of makes this possible with this format, right? Now you're able to put 50 grand in this one, 100 grand in here, and just spread it around several dozen deals, right? And, but if you're not the one operating it, you're somewhat infinitely scalable at that point, right? The general partners, the people in the cockpit are running the deal for you and incentivized to do that, right? When the deal makes money, they make money. So that's kind of where I think this framework kind of comes hand in hand. And this is where I started to realize, and it got confirmed by, so many people that I would build connections with, like, yeah, this is the way they morph their portfolios and stepped up from the second floor of the wealth elevator to the third floor.
And so I guess the hardest part really is finding these groups. Did you just stumble across it? You mentioned that you'll just talk to a couple people, but now that you're there, is it like a website that everybody go to, or is it just kind of like, it has to be word of mouth to get into
It is
these
kind of
different
word of
things?
mouth. I mean, there are websites, but unfortunately, as you know, like once there's a thing, now you have all these fake review sites and people pay for sponsorship, pay to play, right? And oftentimes the best marketers are kind of pushed the most. We try to find like the most introverted operators and to partner with. Those are like oftentimes the best deals to get into. But yeah, it's kind of a shadow network to be honest, right? I mean, you're talking very little amount of people who are accredited investors, million or greater, and also invest this type of way. Your second generation families, third generation, your family wealth, they've already got their connections. And I mean, what's kind of, I guess it's not a surprise, but a lot of them just don't invest at that point, right? The kids are just kind of spoiled kids and just living off the family wealth. I think one consistent thing that we see in our community is this component of first generation multimillionaires. If you see the things that you're investing in, they're not flashy, sexy things. They're just more blue collar type of assets that make a lot of sense. That's kind of hard coded into, common American needs. But yeah, I think that's, answer the question. I mean, the way I found it is, I just started from the bottom and just started to chip away through these networks. And, it took me a long time. And part of that is just going through a lot of garbage networks too.
Hey, you gotta find a diamond in the rough, right?
Yeah, I mean, but if you know what you're looking, I think that's the thing. If you know what you're looking for, you usually can vet things out by like looking around and seeing the quality of the people around you, right? Like for example, the local REIA is probably one of the worst places to go and look, because at the end of the day, not to typecast people, but what is your net worth, right? Most of those kinds of things, you got people running around wholesaling houses, flipping houses. Their net worths are usually non-accredited investors doing that type of stuff because they have to, right? They haven't accumulated that critical mass of $500,000, $1 million net worth to be on the more passive side.
Sense. And because I'm thinking of like, even though there are a lot of deals obviously being done locally, it's just you need to know the right people that are doing it. Because like even here in Maryland, like, you know, they got data centers that are popping up left and right. And then there's obviously hotels that are being popped up, or even multi-unit apartment complexes that are going up. Somebody had to make that deal, but they had to do it somewhere. And it's like, can you possibly like reverse engineer or even reach out to them and be like, hey, you know, I would like to be part of the next one?
Yeah, but typically, like I said, majority of these projects that you're mentioning, they're done by a large institution. Especially data centers, right? Like, I mean, a lot of that is more institutionally ran. So they're not looking, unless you're an individual investor bringing like a $5 million check in, they don't even want to talk to you. But so yeah, you're kind of looking more for the grassroots operator. But you know what? Like once you start to grow with a set of operators, you and your net worth and your check sizes will grow too, theoretically too. But there, as you're saying that, another thing to think about is like if you're talking Washington D.C., the numbers aren't going to work there, right? Like to do some of these things, and that was goes back to invest where the numbers make sense, but live where you want. So you are likely to have to get off your butt and travel to these things, which is a big daunting task when you don't even know what you're looking for. And then yeah, like that's the other thing is like you just look around the room and the people that you're in these groups, like what is their net worth, right? Like I can kind of think about our group. Most of the people are in their 50s at this point. And then the hard thing too is, when your net worth gets a little bit higher and, you're trying to hide from people, right? Like
Right.
from a privacy standpoint. So you're not around flashing your money. A lot of these people, they have kids, they have run businesses, very busy. They're not going to some like happy hour real estate meetup. Heavens no, those are like for the young active guys who don't have too much money. So those are a few things additionally, kind of working against you. And I think that's kind of what made our community so unique is, we kind of put on the events specific for that person. But, obviously we vet people coming in, right? We don't let non-accredited investors come to events, for example. But, that's kind of the typecast, the profile you're looking for, I think.
So
But to get into
exclusivity,
those rooms, you
yeah,
yourself need to be accredited, $1 million net worth or greater too. So
okay,
typically,
or have the income of 250 or more.
yeah,
Okay,
yeah.
so close. So
So if
getting
you don't, read my book,
right.
take advantage of the free course I have, buy some rentals, and we'll see you in a decade.
So talking in the future a little bit, because I mean I'd like to talk to you more about the secret behind the door stuff. But far as where do you see as you could say, the new conversations are going in the future in real estate?
I mean, I'll echo some of the things that Howard Marks said, right? Like we're coming out of a period of 0% interest, like free money. Real estate is highly dependent on interest rates because real estate, unlike other asset classes, heavily leverage. And that's one of the good things, right? The banks really like the asset, so they'll lend on it. But when interest rates are sky high, right, like how it is, it's just, your trade winds are cut off. And if you look in the future, your best indicators of what interest rates are going to be is on your FedWatch CME tool. You can Google that, and your Chatham Financial. Those are two industry sources that we use. They're predicting interest rates, the Fed rate, not to come under 3%, maybe in the next decade. So I theorize that real estate has kind of lost a big trade wind behind us. That said, I have a lot of real estate. I will continue to have a lot, but I'm just saying, like, you know, you got to look elsewhere. And this is why we've kind of also looked to buying businesses and business M&A, venture capital, private equity, things outside of the realm of real estate. Although I do think that, at least speaking from our past, our real estate is our bread and butter to operate. But yeah, like what got us here isn't going to, take us to the next levels that we talk about in our business meetings a lot. And, something's always changing. I think something you said in the beginning, I hate to go all in. But let's be honest, dude, like if you don't got much money, you have to concentrate on something, right? The only people who have the luxury of playing it safe and diversifying over 10 to 15 things are people who already got the money. And the only reason why that the so-called experts tell you to diversify is so that you don't lose your money and then you get upset with them, right? That's just the plain vanilla CYA advice, right? Now, I'm not saying to go invest in crypto or real estate, right? I'm saying that you have to put the stake in the ground and you got to go after it. I got lucky because I rode a good wave with real estate. It also hurt me when commercial real estate corrected 20 to 30% off the peaks a few years ago. Let that sink in, right? Because that's the real hard truth right there. Education, that's cool when you got money, but if you're broke or you're under $1 million net worth, then I don't know if it's going to cut it. I mean, or you could keep doing the standard, invest in the 401k and, that's going to take forever. We know what's going to happen.
Yeah. But you'll
I don't
be
know.
50,
Any
60 by
feedback
the
on
time
that? I
frame.
mean, it's a little controversial, but like, that's the real talk right there. Yeah, I'm not giving any financial advice, but, just playing out the scenarios here for people.
No, I appreciate the truth behind it all because that's kind of where we at, and the real listics behind the things that a lot of people are trying to play $1 million games with $100,000 income. So love it. You ready for the final four?
Yeah.
The final four questions are the last four questions of the show, and we just kind of get to know a little bit more about you. So the very first question is, what does wealth mean to you?
I think it's a passive cash flow number. Again, most people will say $10,000 to $25,000 of passive income a month. I think 25, that's a pretty nice, rich life. I do think once you get to that level, you're spending like 50 grand, 100 grand on like bigger purchases here, there, vacations, vehicles, nice things. That's why it always seems like a more legitimate $15,000 monthly burn rate and then some extravagances sprinkled throughout the year. But, more than that, I don't think you need much more of that, I mean, I think a $3 to $5 million net worth can create that income stream. So, but, I always say it's more of like a burn rate. Having that passive cash flow stream is really what you're trying to shoot for at the end of the day because you're going to consume it anyway. So what does that create? Well, I mean, life doesn't make, life's not the end all be all, but it sure makes life a lot easier and a lot less resistance for annoyances. But yeah, it allows you to do what you want with whom you want on your terms and gives you a little bit of time freedom too.
Number two, what was your worst money mistake?
I probably shouldn't have bought like as many rental properties. I probably should have just done a few and then moved to the syndications and private placements earlier. But hey, I didn't really have any help. Nobody was really guiding me. I didn't have the Wealth Elevator book back then kind of showing me what was in the outer spheres. I think another thing that I realized, like at some point you switch from trading time for money and you have enough critical mass net worth, right? For some people, that's $1 million. Some people, that's $4 million net worth. But at some point, you switch to this family office mode where your job is not trading your time for money, but now being the good steward of your wealth and investing it the right way. So I think if I finally kind of realized that myself, that's my job is to go invest my family's net worth and find good operators, find good deals out there, than to just keep the churn, right? Trade time for money, whether that means if you're a sales guy, sell stuff. But there's a flip, right? Some people who are business owners, they stay on that mode their whole lives and they grow their net worth well past $10 million net worth. I think that switch needs to happen a little bit sooner, and we kind of talk about this in the third floor of the wealth elevator where you switch to being more of a professional investor where that's your job, right? Your job is to invest.
Number three, Is there a book that inspired your journey or changed your perspective?
No, not really. I mean, it was always like you put books into two categories. First, if you're working on something, like you're a little unhappy with this thing gets to you, you read, what's the book I'm reading now? Let Go or Let It Theory, I think Mel Robbins
Oh,
or
Let
something
It
like
Go.
that.
Yeah,
Yeah, Let It
yeah.
Go.
Oh, Let Them.
Yeah, let
Let
them, let
Them. It's
them.
called Let Them. Yeah, yeah.
Yeah. She also wrote the 2-minute rule. I mean, not breathtaking, innovations, right? But, to me, I read books for like if I'm working on certain problems. Here's a hack, like I'm part of I have like my board of advisors, like a CEO team. So, we kind of share struggles along. I think that peer group is very important. But sometimes, we have to practice what we're going to report, right? As opposed to just wasting each other's time and coming off the hip. So I'll take that and I'll throw that in ChatGPT and say, well, give me some book recommendations for some things I'm dealing with. So that's actually helped me recently too. But yeah, nothing's that really like kind of been an overarching guiding thing. It's always been kind of micro movements like this. And I don't know if there's really a book for that, the big high level stuff. I think financially speaking, my book does that maybe, right? Because it kind of
There you go.
talks more about like high level stages of the wealth building game from the first floor, second, third, penthouse level wealth elevator. But yeah, I've always thought of books as being more micro help here or there.
I like the way how you do that. Because it's almost like you fail often and fail fast, just to kind of get where you need to go. Like, how do I get this solve this problem a little faster?
Yeah, I think like if you're looking for more overarching support, I think that's where you gotta suck it up and pay for a coach. Whether that's, $500 a month or, $2,000, $3,000 a month, right? Books are like a one-way messaging system where the coach just gives you feedback and holds you accountable. That's really the next step there. I mean, you can kind of cheap out and get some of these so-called masterminds, but um, to me,
How
I
you feel
think
about that?
like you might as well go the whole way and get that committed person to your success.
All right. Number 4. What is your favorite dish to make?
Sushi. I always tell myself that when I get enough time freedom, I'll go and like be a grunt worker on a sushi line just to learn how to do it like really good. Yeah.
That's what I try to do most of my vacations is to try to learn something every vacation to learn a new skill. So that's what I do.
Yeah. Cool.
Pretty cool. So the last question of the show, which is, where can people find out more about you?
Yeah, if they're podcast listener, they can check out my podcast, The Wealth Elevator. Been doing it since 2016. They can also buy my book, The Wealth Elevator, on Amazon. And a special offer, if they buy it, email me the receipt at team@thewealthelevator.com. We'll hook them up with the PDF version and the MP3 version. So in case they're like me, they can't read too well, they can listen to it.
Hey, I'm the same way. I read slow, but I listen fast.
Yeah.
Thank you so much for your time, Lane. This has been amazing. And for you who are listening right now, if anything that you got out of this is that where you are right now is where you need to be, is that you need to continuously read a book, continuously pivot yourself, and really solve the problems that's blocking you right now. You need to get out of your way and make things happen. So, by all means, continue to live your life and be happy where you are today. All right, y'all be safe. We out. Peace.